Hello, friends, and welcome back to Market Shares. I'm your host, Tony Blodgett, and today I'm going to talk a little bit about what's happening in the news here in the mortgage industry. I am going to cite some articles that I was looking at on Housing Wire today. And, it's always interesting, especially these days, to go in and see, all that's happening, in and around our industry, because, we hear a lot about what's going on in the, geopolitically and, with tariffs and all this other stuff. But so much of this also trickles down into the housing, mortgage, and real estate industries. And there is a lot of different changes. I've spoke about the CFPB being a large one, and I'm actually going to speak about something new that happened with the CFPB just today. So I'm recording this on May 13th. And so this article just dropped today. So I'm going to touch on that briefly. But I will say this, a little bit about the market in general. Over the weekend, there was a tentative deal made with China, which put a 90-day pause on the tariffs, most of the tariffs with China. Some things were excluded, and of course the 10% baseline is still there. But as a result, the stock market has rallied, and at least in the first part of the week. And, as much as that's good news for, I think, our economy and the market overall, the reality is mortgage interest rates have taken a hit. And so we've, seen more, volatility in mortgage interest rates. And it's just like, when is this going to end? But despite all of the chaos over the last couple of months, we did see mortgage applications, rise, actually lock volume in particular, rise 3.2% in April. And so I think what we're seeing right now is, despite all of the disruption, despite the fact that interest rates are still high, the housing market is still quite strong. Now, we're starting to see a few things. We're starting to see a little bit more foreclosures. I've definitely seen some of that going on. There's some articles about that. I actually saw a short sale the other day, which I hadn't seen one of those in a long time. So, but we're still at historical lows. So despite what anyone else might say about the housing market, delinquencies are at all-time historic lows, but starting to show some signs. Also on the inventory side, we're starting to see more and more inventory stack up in certain parts around the country. Some of the highest levels we've seen in many years. I spoke in a previous podcast about the opportunity right now to get seller concessions in many cases. That's just a sign that there's more inventory available and sellers are willing to be a little bit more negotiable. And that's super helpful right now with interest rates where they're at. You can negotiate to fund a temporary or a long-term buy down or something like that. So there's definitely some bright spots in the market. And all this says to me is that if we do get to an environment where interest rates are lower, which, I still think is going to happen. Maybe I'm just an eternal optimist. I still think that that's going to happen as we get towards the later part of 2025 and things settle down a little bit. But just despite all that, we still see really strong housing numbers. And it's a little crazy, to be honest with you. Also in the news recently, inflation numbers obviously look still really good. Inflation's still very low. But keep in mind, we have not seen a full month of what the reports look like since the tariffs were imposed at the beginning of April. So we will be waiting to see what that direct impact is on inflation. And that could just bring a little bit more volatility to what it is we're dealing with here in the housing and mortgage industry. But we'll stay on top of it, be watching all of that very closely. And I encourage you to do the same thing. I've talked about this on the podcast. If you don't have a subscription to, some of the mortgage news websites, Housing Wire, things of that nature, I encourage you to maybe invest a little bit right now in getting access to some of the best resources that are available to us as mortgage and real estate professionals. Because with so much uncertainty that our clients are dealing with, it can really help when we can bring facts and knowledge and details to those conversations. So I don't feel like there's ever been a time where it's more important to be up on what's going on. And keep in mind, headlines never tell the whole story, right? Headlines are intended to be sensational, right? And typically slanted negatively because that's what gets people's attention. Same with the news and everything else that we watch. And so it's up to us to dig through the details and say, well, yeah, that's what the headlines say, but let's talk about the reality of what that, article was about or that story is about and give a little bit more context. And then you become much more valuable to your client. And in my opinion, part of our job is to help people rationalize their decision to purchase a home. And sometimes, especially in a market like this, that requires some counsel, some education, some guidance, and you can be that person for them if you have the knowledge. So just a little plug there for our friends in the news industry that are providing great content for us here in the mortgage and real estate space. But I do want to circle back on this CFPB article that dropped today. Now, you guys all know, if you did not watch my episode about the CFPB, please go back and watch that episode. I got a lot of great feedback about it. And, this is interesting. So today, the CFPB rescinds 67 guidance documents. Now, I had talked in that previous video about how of late, the CFPB under Rohit Chopra, hope I'm saying that right, the previous administrator, under his leadership, he was appointed by the Biden administration, had given a lot of these guidance documents. Matter of fact, there was 67 guidance documents that were rescinded today, and 64 of them came under, his leadership. And so he used these guidance documents a lot to set policy. Now, a lot of people saw that as helpful. Matter of fact, I did. I'm like, it's nice to have some clarity from the CFPB on what their expectations are. But as I was reading this article, as I got more of the details, it turns out Trump had actually signed in 2019 an executive order that agencies should not create rights or obligations through guidance documents. So there was this previous order from the Trump administration, previous term, that said agencies shouldn't do that, and CFPB being one of those agencies that shouldn't do that. However, that was repealed by the Biden administration. And so under Chopra, we saw a lot of these guidance documents comes out. Now, I thought it was interesting that both the American Bankers Association and the Mortgage Bankers Association both were in favor of them repealing these 67 guidance documents. And I'm like, well, I wonder why they would be supportive of that. And basically the feedback is that oftentimes the CFPB would adopt interpretations that are inconsistent with statutory text and impose compliance burdens on mortgage companies, banks, etc. And so I think that's interesting that, and keep in mind, the ABA, the American Bankers Association, they're regulated by a lot of different entities. It's not just the CFPB. Everyone knows that the banks also have to deal with the OTC and FDIC and all these different regulators that the banks deal with. And so when you have this overarching guidance from the CFPB, sometimes, and this makes sense, they might take a little bit different interpretation than other regulatory entities. And so it creates a lot of confusion for banks that are trying to adhere to what the CFPB has said, if it might be different. And just like in the mortgage industry, we deal with a lot of state regulators. Well, it's oftentimes that the CFPB would give out these guidance documents. So at least we know where the CFPB stands, but it doesn't always align with state regulators and so on and so forth. And so, when I read that, I could kind of see why this makes sense. Now, they did not say that this would be a permanent repeal of these guidance documents. It's possible that some of them get reinstated. It's possible they get rewritten or clarified, and maybe many of them just, go away completely. But it is interesting because now there are some items, many of which are around, credit reporting. There's some around loan officer compensation. There's different guidance documents that had previously been looked at by many companies and many compliance departments as, okay, now we have clarity on what the CFPB wants to see. And now that clarity is gone. Now, that also happens at a time where does not look like the CFPB is doing a whole lot of enforcement either. And so, it kind of leaves people in an interesting place to then interpret for themselves what it is the CFPB is looking for. But anyway, this is just more on this story that I wanted to share with you guys, and it is creating some confusion. So don't be surprised if, some companies might say, well, that guidance document is no longer in effect. So maybe this policy that we wrote based on that, maybe we feel open to changing that, right? So we might see some of that stuff happen in our industry. Now, one of the big complaints about the CFPB going away is that they were the main entity that was regulating for RESPA. And a lot of people are saying, well, with them gone, now the enforcement of RESPA violations is really being pushed back to a state level. Matter of fact, I would argue that what the Trump administration would want to see here, and this is what it feels like to me with this whole repeal of the CFPB, is that they want to push it back to the state level, right? I mean, he's done that with other things. He did that with the Department of Education, for example, right? Like, we're going to basically shut down the Department of Education, and we're let the states handle that. So this is, not, out of sorts, if you will, for kind of the mindset of the Trump administration. And it feels like that's kind of what they're doing here is, the feedback, and you heard Elon Musk talk about this, you've heard Trump say it, is that the CFPB is just a redundant organization that's unnecessary. And so, again, watch my other video if you want my opinion on that. But the point being is that if this is shifting more towards state regulators, is that a good thing or a bad thing? Well, let's talk about that for a second. I mean, the challenge with it being pushed to a state level is now you have 50 different interpretations of these rules, right? At least with the CFPB had these guidance documents out there on many topics. It was like, okay, it's very clear. We know what the CFPB is looking for. They've provided guidance documents that tell us. So when it's at a state level, now all of a sudden this is open to interpretation. And I'll give you an example of one that I was reading that I thought was very interesting. There was one state, didn't say which state, but one state that interpreted loan officer compensation rules to read that a branch manager, or any manager for that matter, could not be paid override based on, and get paid basis points on override, which is a very common practice in our industry, right? So a loan officer makes certain amount of commission. A branch manager might get, a couple basis points of override on that production. That's how the branch manager or a regional manager is compensated. Very standard practice all across our industry. And yet we have a state regulator saying, well, our interpretation of loan officer compensation rules say that you can't pay override to a manager who was not involved in the origination of that loan. Now, can you imagine the impact of that? So it's items like that that could make it very difficult if we see the CFPB continue to be shuttered and more of this responsibility pushed back at a state level. You just get these different interpretations. And like I've mentioned in the past, some states are really good, and do a great job, and other states, maybe not so much. Maybe they just don't do a lot of enforcement at all. Maybe they don't have the budget for it. Maybe they don't make it a priority. And so bad actors kind of can slide beneath the radar. But here is one of the other potential benefits, in my opinion, of it being shifted back to the state level, which is the small players, right? The small companies, like even a small, independent brokerage or a small independent mortgage bank that right now under the CFPB, let's be honest, they kind of fly under the radar, right? The CFPB is pretty well known for being focused on the largest lending institutions because obviously they have the financial wherewithal to deal with the level of audit and review, because you got to pay for all that the CFPB might bring. But they also have the ability to deal with, any action that may come from that. They can afford to pay the fines or to settle with the CFPB. And so they have deep pockets, let's just call it what it is. And they have been a target. But then there's a lot of these smaller players, state, companies that are maybe only in one or two states, or small independent companies that maybe are doing things that are not as compliant, and they're doing it because they're not worried about the CFPB. So if you start seeing RESPA compliance and all these other enforcement being pushed back to the state level, well, then they're going to have to heighten their review. And it's typically the state regulators that would be looking into these smaller players. So in some ways, that might level the playing field. It might take some of the more well-known things that are happening with small companies that I think a lot of people know might be happening, but they haven't really been enforced. Perhaps, that would be a benefit of taking some of that away and pushing it back to the state level, because it might make everybody be a little bit more compliant in their activities. So anyways, just an interesting take. I find this stuff fascinating. I think it's very interesting. I've always been involved in, compliance and the regulatory side of our industry. So, maybe not something that everybody's watching, but I think you should be aware of it. And when you think about the company that you work for, or if you own a small company or whatever it is, you should know these things that are going on, at least at some level. And I think the big point here is that we continue to see the CFPB shrunken down. And a lot of people think, well, that means that oversight is going away in the mortgage industry. And what I want to remind you is I don't think that's going to happen. I think what's going to happen is we're going to have less clarity on what's expected, because even with these 67 guidance documents going away, that's, whether you liked them or not, or whether they were the right interpretation or not, at least it was clear. So that goes away, and there will be mandates. If they shut down the CFPB or continue to, minimize its influence, there will be expectations on state regulators to fill that gap. And some people might think that's great. Some people might not think it's great. Depends on the state that you're in and how it is they do their enforcement. So just know that it's not really a removal. It is a shifting of who it is that you may be accountable to. And look, I don't want to make it sound like state regulators didn't exist during the time of the CFPB. Of course they did. But specifically around RESPA and some of these other rules, they did just defer to the CFPB, right? Because the CFPB would work and share information with state regulators. So there's definitely certain things that it was known that the CFPB was looking for. And although the state regulator might be looking for them, they certainly didn't make it a priority. And now they may make it a priority. And how that manifests is yet to be seen. So anyway, thought that was interesting. Look, I guess at the end of the day, my message from this podcast and this episode is know your news. Keep up on what's going on. Get your subscription if you need it to wherever you can. There's plenty of free information out there, but make it part of your normal business to be a student of these things. I've found over my career that whether it be my understanding of fiscal literacy and interest rate movement and what's going on there, or just knowing the rules and regulations, or whether it's guidelines and programs, the more knowledge that we can acquire, the more valuable we are to our referral partners, to our clients, and to our companies, frankly, right? You become a resource potentially to your own organization and get the opportunity to give input. So that would be my message for today. I hope you found this conversation interesting, and I'll continue to keep an eye on what's going on with the CFPB because it's something I'm interested in. And whether you believe it or not, or whether you're interested or not, it does affect every single one of us in the mortgage industry. So if you like this content, you like this episode, please share it with somebody. Let someone else know about what we're putting out here on Market Shares. I would appreciate that. And of course, subscribe to the channel, because every single Friday we put out a new episode, and you don't want to miss one of those, right? So I'll see you next time. Take care.